Yo.
Hey, happy Tuesday.
That's what it is. It's not just a happy Tuesday. It's not just a happy Tuesday,
What is
Jolene.
it? Taco Tuesday?
Taco Tuesday.
Yo, I don't want to hear nothing about no freaking tacos right now.
I need my wife's tacos in my life. For those in whom which that have been blessed enough to try Erica's tacos, you know they're legendary with the jerk salmon, and then with a little bit of mango or no. I make a habanero jam that tops it. And then, of course, my wife, she just does magic. I mean, I don't know what kind of witchcraft that is or sorcery, but those tacos are amazing.
It's hella good. It's hella good.
So I need that in my life. But you never know. I mean, since next week, we may not be live next week, and there's for a specific reason. But we'll get into that after we come back from the intro, because what's up, everybody? This is Mark Monroe, accompanied by my wonderful co-host, co-producer, and co-creator in all things galactic. Give it up for none other than the wonderful.
It's Jolene GC in the place to be. What does it, cousins? Happy Tuesday.
Yes, we got a lot to get into. So without further ado, go ahead and cue that intro. All right. So we got a lot to get into today because we have a jam-packed show full of topics and everything else. You're seeing us in kind of like a rare form, but it's always oldie yet goodie. You know how we do. All right. So, but who was first in the chat? I think it was somebody it was Uncle Charles, right? Yo, talking about they're back.
We back.
We're back. Salute to you, Uncle Charles, for definitely having your notification bell turned on. We definitely love your support and everything else and what you mean to the show. So we salute you today. And if you want to be shouted out in the show, just make sure you have your bell turned on. Alongside with that, in order for you to definitely be a part of this whole cousins family reunion thing, definitely make sure you are subscribed to the channel. And if you like the video, I mean, we ain't gonna be mad at that. We appreciate you. All right, so just a little bit of housekeeping. So next week I may or may not be here because your boy is turning 38. It's been a long 2023, a long 2022, from 2020, actually 2018 to now. There's a lot that I've gone through and everything else, a lot of, transition. And honestly, it's like one of those ones where it's just like, I just want to kind of like relax, just decompress. It's been a lot. So, we're going to see how it plays out, though, because I never know what the people around me got planned. So we're going to see how it all plays. But, hey, there it is. All right. So, Jolene, what should we get into first? Because we got a lot to talk about, a lot, like a whole lot of.
The things that's top of mind right now is CPI, Consumer Price Index, because we just need to talk about it.
All right. Done. So the shout out to our producer Levick for going ahead and throwing up on the banner. We got CPI data and it reads, "Are we in trouble?" Well, interesting. Let's go ahead and cue that wonderful US Bureau Statistics, or Bureau of Labor and Statistics, to be a little bit more correct. So if you don't know, CPI is a measure of the average change over time as it pertains to prices paid in urban consumers for a market basket of consumer goods and services. So indexes are available for US and various geographical areas. Average price data for select utility, automotive, fuel, and food items are also available. So what we're looking for, like we've already had CPE or PCE that came out, and now we're going CPI tomorrow. And so I'm just going to give y'all my take on it. I think that we'll probably still have CPI, if not rise or come in flat, but I think that it's going to be pretty much like a misnomer. But at the same token, the one thing that gives me that leads me to the air of caution is definitely looking at food items and energy. So I think that we're probably going to see energy probably come up a little bit. And then I think that what we're going to see is food in certain areas come down. Now, one of the things that I always tell people, if you want to kind of also get a nice little good read on things, go on over there to our friends over there at Bar Chart, where they have this wonderful source of information where you can check out their future side of things and things to pay attention to. Simple things like wheat, meat, like cattle and all that other stuff, alongside with like things like orange juice. Those can give you somewhat decent reads as it pertains to also where we see the prices of certain goods go up. So there you have it. Like sometimes what I'll do is I'll actually study the future side of like items like food just to see exactly where do we fall. Of course, if you're looking at oil, then you can pay attention to like OPEC, as well as pretty much the entire cartel of hey, are we raising production? If they're raising production, then that means that, or if they're increasing production, then that means that prices probably might come down. But if they're limiting production or halting production, then that means their prices should go up for oil. It's kind of like a simple scarcity thing in which that we look at for energy perspective. You're going to ask me a question, Jolene?
Well, yeah, I was going to ask you, do you know what I use to track my own personal CPI? And well,
the store shelves.
No, well, you're close.
Okay.
Trader Joe's hash browns.
All right, tell me more. I'm intrigued.
So when the hash browns, if y'all don't know about the hash browns are where it's at Trader Joe's. They're the frozen ones. So when they first came out, I don't remember how many were in a pack, but you get like a decent amount in a pack, at least 12.
Okay.
And they were really close to $1.
Okay.
Like $1.29. And over the years, as inflation has increased, those same hash browns, same pack, gets higher and higher, closer to $2. So a couple years ago, they were at $1.99. Now they're pushing even closer to like over the $2 mark. They may soon hit that $3, maybe $2.75, $2.99. Which is still a decent price, but when you remember that it was almost $1, it just makes you feel some type of way in the morning when you're about to have your breakfast. But that is what I look at. It's like I'll just go into the Trader Joe's and just look and see.
Okay.
Still pay $3 for those hash browns. It's worth it because that's like nothing. But that's my personal tracker, Mark.
Well, so all right. So like I said, the expectation is it will show that inflation is still somewhat rising, but I think the biggest thing to look at is it rising, but yet at a slower pace in comparison to like months over months. I mean, everybody always does this thing where we compare it year over year. I mean, if you look at it year over year, then of course you're going to be able to tell that, okay, hey, it's not as bad as, or it's not going to be as high in a change as it once was, or it's going to be showing that. But I like to pay attention to the month over month, because the month over month really starts to show you the trend of things. Like, where are we headed? Like, are we seeing like dips, or are we seeing, kind of like what you're looking at as a stock market chart, except that you can only see the chart change every month. And so again, it's like, of course, markets are like literally rattled of, hey, well, if the Fed literally, will this push the Fed if we see a higher than expected CPI number? Will this push the Fed to like do more than one rate hike? So currently what's on the table is 2 rate hikes before 2023 is over. And so far the market's kind of like saying, okay, yeah, we know that 2 rate hikes is on the table. But, if the CPI data is still being, if the CPI is CPIing the way it should be doing, you like what I did there? Then essentially maybe instead of 2 rate hikes, then we'll just get 1. And we might find ourselves either at a 25 basis point move, or it may just be a straight up rip the Band-Aid off situation with a 50 basis point move and then just call it done. Now, of course, we've been hearing a lot of things from the Federal Reserve, but a lot of folks have been talking about, well, the Federal Reserve has said this, they said this. But one of the things that they also say is that they're forecasting and that they're also looking at what the data says very carefully before making a decision. Whereas in 2022, it was like, look, we're just going for it. And we'll see exactly, how things move. So again, higher than expected CPI reading could lead to concerns about inflation, which could weigh on the markets. And I think that what we're seeing is that, there was some chatter talking about that we could see a potential 100 point move in the S&P 500, given the volatility, given the bottlenecks of what we've been seeing, because the market has been kind of like trading like flat lately. And so again, the question is, what is the market waiting on? Well, I mean, it's very obvious. The market is waiting on what's going to be the read for CPI. So we could possibly be seeing that there's a lot of volatility in tomorrow's event based upon the data.
So they're forecasting it to be 0.3, so less than last month. So if we look at that, plus take into consideration, the employment rate, which is at 3.6%. When we look at the Fed, are you saying that the Fed is more likely to scrap one of those basis points, or are you saying that there's still going to be 2 hikes?
I think, in my opinion, if we see 25 basis point move in this month, then we'll probably see another 25 basis point move. Or, I mean, if it's really like, hey, you really want to just say, okay, hey, like just one more for good measure, one more gut punch, then just go ahead and just give us 50. We're not going to be like, Dylan Brooks and say, you got to give me 40, you got to give me 50. So honestly, in that regard, I think that honestly 225 basis points makes sense, where it leads us to 50 anyways. But like I said, we could see at the very highest, we could probably see 75 basis points added to the table before we come out of 2023. But my best guess is 50 basis points altogether.
Alrighty.
All right. So do we got another topic?
Yeah, let's talk about our favorite, artificial intelligence.
Artificial intelligence. Okay. All right. So I get this a lot, actually. I get this conversation or these questions a lot of, is AI real or is it a fad? Well, first things first, for everybody who has now been introduced to AI, welcome. I'm glad that you're enjoying the tools of generative AI. But I mean, let's make no mistake about it. Like artificial intelligence, machine learning, GPT services, which is generative AI, and other sources of it. We've been seeing this stuff around for years. And so it's not a fad. It's actually something that's definitely here to stay and ultimately growing over time. Now, what does that mean for, say, for example, everybody that's looking out for, earnings and stuff like that, or just looking at companies, right? Because that's where it ties to when we look at not earnings, but let's look at companies in general. So you're seeing a lot of companies that are making that shift and saying that, okay, hey, we're definitely, shifting more so towards AI tools and everything else. I think there was a company today that reported that, I think it was Shutterstock, that said that they're going to add generative AI or AI tools in there so that way you can edit photos and everything else. I mean, that's great. But I look at it like this. That's just I think that's more so the consumer part, alongside with some of the smaller business cases for it. I think that we're still waiting on some of those larger shoes to drop where, now you start using those AI tools and everything else to start solving actual problems. Like, for example, using those large models, not just large language models, because there's more than just that, but like you can literally create a financial language model where essentially it gets into investing, or it gets into fighting things like climate change or supply chain and logistics. Language models are not just like, for example, just the conversational pieces, but using them in other arenas in which that it takes the whole breadth of Main Street. And I think that that's what we're looking for. I think we're still in the very early innings of it. I think that, you guys have probably seen on Twitter where Dan Ives talks about this is like a 1995 moment. where for those that didn't know, 1995 was really like the golden years of the very genesis of what would come for a lot of technological advancements and everything else that were literally starting to boom. Now, of course, you had 1999 that after some folks had missed the bus and then ultimately still wanted to make money, they were coming out with all these ridiculous startups and everything else, and it was just like a money pit pool and everything else. But I think that we're too far from that. I think that we're at the very early innings of seeing a lot of disruption starting to take place across multiple different sectors and industries. So I don't think that this is a fad. I think that it's here to stay. And I'll give some other data points after your question, Jolene. Go ahead.
Yeah, so I agree that it's definitely not a fad. But the question is, how much is artificial intelligence propping up, valuations? Are we, if we look at all the companies that are talking about, like in their earnings, they mention AI, and AI is like an economic driver and it's the bottom line, versus most of those companies were established before, any significant AI mention in their earnings, right? Yep. So, and then we have these other companies like Shutterstock that they're using AI as an add-on. Yep. So I think we need to talk about like that distinction between those that are actually moving the AI needle forward, so to speak, versus companies that are treating it like an add-on and trying to ride that wave of, earnings buzzwords.
Yeah, so that's a phenomenal question. And so if we look at, let's take a step back real quick, because when you examine companies when it comes to AI, judge them based upon these three cores. And I typically look at it also. One, the cost of implementation. So companies are going to be spending exorbitant amounts of dollars in order to essentially make those things like really go. AI just isn't something that you just, okay, we just plug it in and all of a sudden it just works. That's not how it works. That's a recipe for disaster. But so really looking at like how much are they spending to implement that into their actual business and their process. Now, companies like NVIDIA, I mean, you see that they spent exorbitant amounts of dollars, and then you saw like the lineage of how they ultimately got there, like using their semiconductor, a lot of their semiconductor IP to literally move forward and start building a library of large language models, aka LLMs, that a lot of people like really build upon and essentially do their day-to-day business. So, I mean, that's one company. And now you saw it in their past earnings, where you saw that even in a market where, say, for example, PC sales are ridiculously like off, like a lot of people aren't spending money on PC sales. Why? Because they're spending money on cloud services in which that they can do a lot of these things within the cloud that doesn't require them to have to use so much of their own personal computing power. They can just use it from the cloud. That's one thing. The second thing is when we look at it from the standpoint of like the need for skilled workers. So look at the amount of recruiting that some of these companies are doing. Like one thing that you can do as a cheat code, even if you're not looking for a job, go check out places like LinkedIn or Indeed or any of these other places and go check out exactly what jobs are literally starting to hit, like what jobs are new that are newly being created. Because when you have, like, if AI is here to stay, it's going to create more jobs because of the fact that you're going to have to build a moat around it in order for it to be included into the business process. One other thing that I mentioned there about NVIDIA that I failed to mention about NVIDIA is look at how their revenue changed. Like, even in the sense that there was a market that like the PC sales died, but their data cloud and AI services significantly skyrocketed. And that was just the first quarter. So the question is, will we see more of that? I'm probably sure that we will. But at the same token, will they scale it back as it pertains to their margins? Probably so. Why? It has nothing to do with the high cost of things, because we already know that the demand is very much so there. But the thing is, they're gonna do it the Amazon way. And everybody knows the Amazon way is, yeah, we're bringing in all this amount of cash, but are we just going to be like other value-based companies where we just become the cash cow, but we have all this cash and yet we're not doing anything with it? No, they're going to consistently reinvest a portion of those margins back into the company, which should ultimately in the future boost growth as well as future shareholder value. And then the third thing is, again,
what was the second thing? I only have
the need for skilled workers.
Okay, gotcha.
So watch recruiting. So the first thing that we got is the cost of implementation. So
Mhm.
AKA the tools that are being developed. The second thing is looking for skilled workers, because you're going to need people to either build those tools or to also build upon those things and also to improve the process. Another way that we look at how AI has changed things, look at HR departments. HR departments are no longer centralized. They're now more so like embedded across different parts of the business. So if you look at folks who work HR at Amazon, they don't work just, okay, I just work HR at Amazon. No, you work HR at Amazon.com. You work at HR for AWS. You work HR for this division within this company. So they're building individual silos. And the reason why is because with the AI tools partnered together with some of those things, it makes it so much easier and cheaper. And then the third thing is ethical implications of AI, which is going to create a whole new stratosphere as it pertains to legislation and everything else. We've seen even in legal places where we've seen that, okay, hey, where some folks are now getting disbarred for trying to use generative AI or getting fined or sanctioned because of the fact that, again, they use generative AI tools that they didn't fully vet out, and then they used it in court, and essentially they got reprimanded or they're now facing disciplinary action for that. We're, like I said, we're still very much so in the very early innings because of the fact that the disruption is coming so fast that everything else is going to have to take time in order to catch up. And I think that's the reason why a lot of folks think that it's just a fad, because they see the speed of things that are coming forth. But yet at the same token, the world has to catch up to it, and that's going to take time.
Yeah, I think that lays out, those three things really do lay out the distinction between a company that's using AI as an add-on versus a company that can leverage it as an economic driver.
Yep. All right. So, what's next on our list? Ooh, recession. The doom is coming. Is
Question?
it? Question mark. In my firm belief, yes, I do believe that a recession is coming. Now, what kind of recession? Now, a lot of folks are like, "Oh, was it going to be like 2008, 2009?" No, I don't see that happening. What I see happening is, of course, the Fed keeps doing what they're doing and letting something break, but not essentially literally be destroyed. There's a difference between something breaking and then something being completely destroyed. I don't think that the Fed is going to literally tank the economy and everything else. The Fed is going to ultimately put the market into the overall economy into a recession by slowing us down, which allows prices and everything else to start to stabilize. And I think that that's what their focus has consistently been as it pertains to their mandate. Now, have they gotten it completely right? Absolutely not. Could they have moved a lot faster? Say, for example, in 2021? Yes, they could have. But, hey, you can't cry over spilled milk. The only thing that you can do is wipe it up and essentially keep moving forward. And I think that that's what they're doing. So when we think about Fed rate hikes, they're expected when you find yourself in high inflation environments. And we're still in a high inflation environment. Before the pandemic, I think that we were sitting at a 3% inflation rate, if I'm correct. Either that or about like two and some change. And so, ultimately it's going to, like, think about how long it took for us to get up as it pertains to spiked. So when we spike, things go pretty fast, just like AI, how fast it spiked. In order for things to stabilize and come down and meet a new normal, that's going to take time. And if we look at what the Federal Reserve is doing, their projections are also over a 3-year period. So they weren't expecting these things to really take place over a 12-month span. If anybody thought that we would be at a 5 or 6% inflation rate, and then ultimately we would just get down to, or we would get to whatever the high inflation is, and then we would just be back to 2% just like that, that's not going to happen. It was not going to happen. So when you look at it over a 3-year standpoint, though, could we see ourselves hitting that 2-year target, or hitting that in 3 years? Could we hit that 2% inflation target? Yes, we could. I think that the new normal, though, is definitely going to be 3% inflation.
Yeah, so, and also a reminder to look at inflation from a global perspective as well, like how other countries are, what their inflation rates are, because I believe ours is pretty low compared to the rest of the world.
Yep. So, which leads into like what we talked about, like, again, if you're thinking stock markets, pretty much simply put, if the CPI data shows inflation is still rising, stock market could sell off. If we see that the inflation data shows that things are coming under control, we'll probably see a market rally. If the Fed announces a rate hike in the coming months, that then the stock market could definitely sell off. But I think that, it's actually funny because it's perfect timing around this time. Average on an annualized basis, the market tends to stall out around this time in July. And then normally in August and September, that's normally, since you're not getting as much volume as you normally would be accustomed to, you're probably going to have a sell-off when it comes to the stock market, and which ultimately turns into a 9 or 10% correction. And for anybody that saw my Twitter account or wherever else you may have heard me place, my thought process, I think that my projection for the S&P 500 is at 4,000 as it pertains to a target for correction, which would be a healthy 9%, roughly, correction. And then essentially it's like, okay, hey, we pick right back up around September. And it's kind of interesting because around the time of corrections normally typically come to their end close to around the same time that we see federal budgets ultimately close out around September 30th, and then pick right back up going into the next year. It's fairly interesting, but if you ever want to do some extra reading, go check it out.
All right, what we got next?
I have no idea. Credit markets. Ooh. Okay. So if we're going to talk about, let's say, if we're going to talk about recession and inflation, then of course we got to talk about credit markets. Now, credit markets, I think they're already starting to tighten. The yield curve has inverted, which is a sign that investors are expecting economic growth to slow down, right? I mean, I feel like that's an easy one. This could lead to a decline in corporate earnings, which we have seen in some areas, but not all of them, which could weigh on the stock market. So think about it like this. Fed rate hikes will likely lead to higher borrowing costs, which we've seen. Like if you've seen housing and everything else, that's naturally what's transpiring when the Fed raises rates. So as the Fed raises interest rates, it will become more expensive for businesses and consumers to borrow money. So which means that the requirements to borrow money. So one of the things that I would probably pay attention to is definitely student loan areas, personal loan and consumption in those areas, consolidation, those types of things. I would definitely be paying attention to those. And then also looking at corporate borrowing as well. So all those companies that are looking to borrow cash, notice how you're seeing people looking to raise money using the stock market as a stock offering than versus taking out loans right now or taking out debt. There's a reason behind that. So again, those things. So when businesses make less investment, then that leads to economic slowdown and growth. And then of course, the other part to that is stock market. We've been hearing a lot from, many different various talking points that the stock market is overvalued. So the S&P currently is trading at I think it's a PE ratio of about 20, which is above its historical average. So that means that essentially that investors are naturally paying at a higher price premium than paying for, something that's a little bit lower premium, which ultimately formulates a deal. So let me give you a perspective here. So that way we can kind of bring it all full circle. If you're I'm going to bring you guys into the startup world. So let's say that, if you had the opportunity to invest in Meta early on, very, very early on, back when Mark Zuckerberg was still a student at Harvard, would you make the investment into Meta or into Facebook at the time, or the Facebook when it was at that time? Most likely your answer is going to be yes. Okay. So, but then when you get to a place where okay, hey, depending on where you sit, let's say the company is raising another round of capital years later at, let's say, $1 billion, but yet the offering of what you get is way lower. Are you going to pay that high price premium? Probably not. It's going to price out a lot of folks because they're going to think that, oh, wow, that's too rich for my blood. I'm out. And that's okay. And that's what's ultimately what you're seeing right now, where people are saying, okay, hey, the S&P 500 right now is too expensive based upon what we're seeing in the market because credit markets are tightening. The Fed is still raising, they're still raising rates. And essentially we're starting to see that companies are also they're also starting to get a little bit tighter in their finances, AKA look at how credit markets are also affecting companies like a la Microsoft. Now, Microsoft makes a lot of money. They have a lot of cash on the sideline. But tell me why, after they've already laid off X amount of people, why are they going to be laying off more people?
It's for the margins.
You got to protect things. And again, it's like that leads to exposure. So investors should be mindful because, again, when we think about this, it feeds towards a risk tolerance. So what is your risk appetite? Are you able to accept the risk, understanding that essentially that, that you could probably we could probably head down lower. And again, it's like a lot of times people think about it just from a simple standpoint of consumer borrowing. So like, for example, where we're talking about those personal loans, student loans, and all that other stuff.
Mhm.
But it's more than just that. Like, think about businesses that need to borrow money in order for them to actually get started. Well, the cost of capital or the cost to borrow has now gone up. The requirements when they go to banks has now gone up. So when you think about it, they're going to have to put up more collateral in order to get that loan for a business. When you think about it also, they're going to have to, like, if you're looking at a reshoring deal, there's going to be more requirements to actually close those deals because of the fact that, again, you're in a tight credit market. And when we get to when we think about it like that, I'll make it more human for everybody. I'll remove credit and I'll look at the job market. I'll just replace job markets.
Okay.
So what happens when the job market is on fire, then that means that everybody's getting jobs, right? You get a job, you get a job, you get a job. But when job markets start to get tight, what happens?
People want jobs. Like, if it's tight, you're not going to get a job, or you are potentially stuck somewhere. Even if you want to leave, you can't. So it's stagnant. And then if you're not able to move up because the jobs are tightening, then the people that are coming after you, there's nowhere for them to go because you're in their position when you should have been promoted. But if there's that contraction, there's no money for those promotions.
Correct. And so if you remove those things from, say, if you remove the word job and replace it with credit, it's pretty much the same thing. It's going to start getting tight or even tighter. And when you do that, you slow down the economy because now the business investment starts to slow. The consumer spending starts to slow. And that's what they want. Next case. Ooh, earnings snippet. Wow, this is like going like directly like in order.
Yeah. Earnings season. I feel like it feels like it's so short. Like, we just talked about this and now we back.
Yeah. So, okay. So let's talk about earnings real quick. Cause a lot of times like people are like, okay, hey, Mark, we see that the market is up, but do the earnings reflect that? Now, remember what I talked about NVIDIA? You're going to have companies like that are misnomers, but then at the same token, now they're trading at valuations that are ridiculously high. So what you could see is, even though that they have a good earnings and solid beat across the board, or they came in line with earnings estimates and everything else, if people are still willing to sell, they're going to sell. Now, one of the things that has been definitely propping up things, and I think that it's not like going to be a doom and gloom situation. I think that the things to pay attention to is, of course, the impact of inflation. So investors are definitely going to be still paying attention to that, especially for companies that have been like literally like pigeonholed due to inflation. I think that the economic growth story will definitely play a huge role into earnings. I mean, we saw that AI was still there. I think that AI will still be a part of the conversation. But I think that now that we're in mid-year and going into the closeout of the year where investors are starting to look towards the future, now it's like, okay, hey, well, what are we looking at? Like, and I think that the thing is like, okay, if we're going to be deploying capital in October/November, do we still stay with the horses that have been winning this race, or do we take money off of the table and reallocate our portfolio somewhere else? We're starting to hear a lot about industrials. We're starting to hear a lot about other major players. And that's fine. That's okay. I like a bull market that ultimately broadens itself out, as long as we're not in a bear market, because I feel like bear markets are just too depressing, and I like to see people happy. But yeah, so things to just pay attention to, just to keep it simple: economic growth, impact of inflation, and guidance. So companies that do exorbitantly, that do well, and then also raise their full year guidance, they're definitely still going to be in high favor. The S&P 500 is very top heavy right now. I think that we could probably see some of that rebalancing where they start to share some of that love. But I think one of the things to be careful of is a lot of those fund managers and money managers and folks in whom much that have been holding on to capital. You have to remember, a lot of them are going to be reluctant to sell because of the fact that they don't want to be hit with the 50% capital gains tax and other taxes that go with that for the short term. So if their duty is to return value back to their customers, one, or their clients, but yet at the same token, you don't want to have that eaten up by, let's say, 30% of, let's say, of that is short-term capital gains tax. And no matter what, you're still going to have to pay the money manager the moment that you decide to pull. So that brings you significantly up, depending on what their portfolio management fees are. So what if they say it's 20% or 10%? Well, you're going to be impacted by that. And I think that that's the reason why a lot of folks are reluctant to sell. What they'll probably do is they'll probably boost some volatility up and then ultimately play leverage positions, whether it's covered calls or call spreads, or even just naked calls or naked puts to hedge against their actual overall portfolio weighting position. And essentially say, okay, hey, well, since we can't give up the short-term capital gains, we'll just trade a few of these things here with a small allocation in the portfolio.
All right. So we kind of touched on it a little bit, but future talk.
Ooh, future, the future. Okay. So, okay. So here's some things that I'll say that I will look at as trends for 2024. Mm-hmm. And then I'll also say potential risks for 2024. Is that fair?
Yep, that's fair.
All right. So some of the trends, the key trends that we'll see that will likely continue to shape the markets in 2024, of course, continue growth in AI. Mm-hmm. I think that that's going to become even bigger when we find out next year who else has been investing, who else has been spending for that implementation next year. I think the rise of new technology such as blockchain and quantum computing. Yeah, we talked about that a little bit, earlier, but I think that will probably make a few buzz announcements here and there. And I think that with that, pay attention to Bitcoin and Ethereum. I don't really talk a lot about cryptocurrency here, but I definitely see that there's a lot of institutional interest now that's literally starting to jam pack into that cryptocurrency space. I think that especially when we think about ETFs. And I think the biggest thing is that they go with where their client's appetite is. So their clients want exposure to cryptocurrency, but yet in a safe way without having to worry about, okay, hey, am I safe? You could probably put together a Bitcoin ETF or an Ethereum ETF and essentially be invested into that vehicle and would essentially not having to worry about all the other exorbitant amounts of volatility in that space, which is going to create opportunities for companies like Coinbase. I think in 2024, they're one of the major proponents, especially one of the very few companies that has lasted through a lot of the purge that took place in 2022 and early 2023. I think also the increasing importance of data with large language models and everything else. I think that people are going to get back to the thing as it pertains to data. And I posted a quote or I posted something on my Twitter saying, you are only as useful as the data that you create. I think that's the new world that people will start to understand, start to transpire and take place in 2024. It's an unfortunate event and it's also somewhat dark, but hey, don't shoot the messenger. Risks. I think that there are definitely some serious risks. Of course, we already know the looming risk, which is recession. The slowing of growth, and I think that that's going to bring out a lot of your value players. Focus on the dividend. They got cash. They got a strong dividend and everything else, and they'll probably have a little bit of their moment in the sun. But at the same token, for the traders out there, they probably will have fun next year because of the fact that volatility will step back into the markets in 2024. I expect more volatility to come back into the market in 2024. We had low volatility this market, which, you kind of have an idea of where the market's going. Mm-hmm. I don't think that you're going to have as volatile of a market as we saw in 2022, but I definitely believe that we will have some volatility for sure. And then, like I said earlier, the impact of climate change. I think that will be another risks But even in risk, there's opportunity within risk. So you just got to look carefully. But I definitely believe that what we're seeing that's transpiring across not only just the United States but around the globe, I don't think that we are going to see that slowing down. I think that that's going to continue. So, like, for example, where you have these major floods that are taking place in Vermont, come on, Vermont.
Yeah.
I think there was a flood also in Chicago, Illinois, and think about it. Like, what was it last year? You had a snowstorm in Texas.
Right.
So again, I don't see those things slowing down. I think that we'll probably see more of that, some of that activity pick back, that we'll see more of that pick up. And I think that that can also have an impact on, that brings a lot of risk towards companies and everything else. And when you think about it, supply chain, growth, the growth story for Main Street market, as well as international markets, that's going to play a huge role. And that's, those are just my projections for 2024.
Well, it's a lot to take into consideration, especially since we only have 5 more months, not even 5 full months left of 2023, and it'll be time to start thinking about trading plans and all that for 2024 and beyond. So,
yeah,
it's a good one to come back to,
Yeah. So, how did we do today?
Yeah, 5:41. We did good. I guess it was a 45-minute episode.
Look, man, people don't understand like how tough it is to try to jam pack all this information into a short span of time, and also make sure that it's not only just understandable but also digestible, and on top of that you're learning something, and it also gives you some pieces in which that you can pick up the crumbs for. It's a challenge, and so I try to do the very best that I can, and I know that Jolene does too, because she helps as well as it pertains to the curation of these discussion topics. So I mean, I hope that everybody picked up value there from what we discussed today. And if anything, it's like I said, don't just be scared of the risks and everything else that you hear. I mean, of course, the risk only just keeps you grounded, because you don't want to be left high and dry. But also be sure to take advantage of the opportunities that are in front of you. Weigh the risks, of course, but if the risks, if the juice is worth the squeeze, then go for it. Go make orange juice or lemonade. All right. So thank you everybody for watching. I hope you guys enjoyed. Until next time, I am Mark Monroe.
And I'm Jolene GC, and the place to be.
And this has been Executive Education. We'll catch y'all in the next one. Peace, y'all.